Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest from Option Elements today is Ricardo, a good friend of mine from Spain. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And you can read this entire disclaimer on our webpage at the bottom of any page. And while I'm transferring the ball, I'd like to say a special welcome to Ricardo, a good friend of mine. We've known each other for a few years now. Fellow European, and only you're in the warmer part, which is nicer in the winter. And for the people who don't know you, maybe you want to talk a little bit about your background and who you are, and just that kind of information. So welcome.
Yeah, I will talk. Can you see my screen? No.
Not yet.
Thing is, I did have it up here. Where is it now? Oh, hang on here. I've got it. Share my screen. 922. Okay, right. Got it.
Yep, I see it loading.
Yeah. You can confirm. Yep.
And almost. I feel it coming. There it is. Earnings plays.
Yeah. Okay. You record. Yeah.
Yes, the recording is going on, so we're fine.
Okay, all right. Thanks, Tom. Thank you, and good afternoon or good evening to everyone. A real pleasure to be here. Well, it's my second time here. I'll introduce myself now to all those of you that don't know me. That's me up there in the top left-hand corner at the stock exchange here in Madrid. As Tom says, I'm in Spain. I'm in Madrid. I'm actually British, but I've been living here now for 20 years. My father is Spanish and my mother's English, but my nationality is still British, but I've been about 22 years here in Madrid, happily married with my children, etc., etc. So I'll quickly introduce myself. I'm a professional trader, just options. I mean, 95% of what I do is options. I manage my own personal money and clients' funds and portfolios as well. I actually manage the Spanish division of OptionElements.com. You can see Option Elements down there, the logo of Option Elements down there on the bottom right-hand side. And now, very soon, I'm actually going to be having we're going to be having a second trading room at OptionElements.com. This is I'm managing OptionElements.es, which is the Spanish division. I'm going to have a second trading room with Tony Sizemore at OptionElements.com, which I'll speak very quickly about at the end of the presentation. So obviously, I'm a teacher and a mentor as well. I've just written my first ebook on options trading. That's actually in Spanish. I wrote that in Spanish. And I'm also the representative for Europe of OptionView software. I'm their representative for Europe and for South America. And I'm considered completely sort of bilingual, multicultural, Spanish-English, English-Spanish. I really have no preference at all on which sort of language I speak in, or whether it's Spaniards or English or Americans or whatever that I'm dealing with. I am considered totally multicultural in that sense. Today or tonight, I wanted to talk about earning plays, real money-making strategies, and finish off the presentation with just quickly going over a new alert service that these earning plays are going to be forming part of at Capital Discussions. So without further ado, we'll go on to the introduction. That's still actually Just wait. Correct that spelling error there. All right, and get the chat up because I can't see that. Okay. Right, strategic plays on earnings announcements. That's, for many of you, obviously nothing new. They've always been around. People have always been doing very quick strategies on sort of just before companies release their announcements, and then sort of getting out of the strategies very quickly after. There are other sorts of strategies that you can do on a sort of a longer term basis, playing on volatility as we come up to the day of strategies, but these are really the strategies that we're talking about here are just, I mean, sort of just, we're there for a night. Basically, we're using medium and high volume stock options to do these. Usually, I mean, in 90% of the cases, what happens when a company does have its releases coming up, the implied volatility increases. You know, there's doubt on whether or not the results are going to be good or bad or whatever, and that implies uncertainty, and uncertainty implies implied volatility increases. Prices can move, and they can move a lot, but they don't always move a lot. We're going to be seeing now sort of traditional strategies that have always been around, and we're going to be looking at two new strategies that we've sort of come up with. We have many different sort of indicators and tools, all very sophisticated, on helping us pick the right strategy to do at the right time. And some of these indicators are price and volume patterns, levels of accumulation, distribution, and personalized volatility indicators. So, first of all, to sort of get a base of prime strategies that we want to be dealing with, that we can sort of pick from, we have a new tool with the OptionView software, and it's called the earnings tool, where they themselves have their own sophisticated search algorithms. It's all sort of, the tool I have is sort of based on the last 2 years of data, which means the last 8 earnings seasons. Usually, companies give their earnings sort of 4 times a year. They're usually given in January time, sort of April, July, and October, more or less the seasons, the earning seasons are around those months. And the way in which the tool works at OptionView is that the searches for their base of earnings plays for the week is actually executed every weekend. So sort of every Monday morning or whatever, you refresh the data and you'll get an assortment of strategies that they're sort of saying that are the best ones that are going to be working out. Then we ourselves here at Option Elements, we've got quite a team working for us at the moment at Option Elements, and we ourselves, we pick the best strategies from the base of strategies that we're getting from the OptionView software through our own proprietary algorithmic systems and in-house transaction optimized. It's all very complex. I'm not the one that's completely in charge of this. I've been sort of supervising the whole project, but we've obviously got our own technicians and things dealing with this. But a lot of it is based on the software of QuantStart. And as said before, it's all sort of combined and blended with price and volume patterns, levels of accumulation, distribution, personalized volatility indicators, and risk manager and execution engine. So we're getting the base of strategies from here, from OptionView, and we're picking them using our own in-house software. If anyone has any questions, please ask. I've got the chat up here so as I can see exactly what comments or questions are coming up.
Yep, none yet.
None yet. No, I can see that. It's all clear and concise, my presentation. That's great. Basically, okay, we're talking about 5 strategies, 5 prime strategies. 3 may well ring a bell for many of you, and numbers 4 and 5 are sort of newer types of strategies. The first one are prime movers. Stocks that make big moves. Options tend to be undervalued. Even though the implied volatility is increasing, usually what happens here in these prime movers is it doesn't increase enough to justify the move, either up or down, that it makes after. So it's worth their buying, sort of a straddle or a strangle or whatever, buying options covering both directions, up and down, because usually it's worthwhile doing that. However expensive the options are, they're still cheap in comparison to the move they're going to make. So that's the first one, prime movers. Prime non-movers, exactly, completely the opposite to what we're talking to number 1. These are stocks that make smaller than expected moves. These are stocks where the implied volatility has made them so expensive that the moves they make after the earnings results do not justify those prices. It's actually better to sell those options. It's better to sell a strangle or to sell a straddle rather than buying options. They tend to be options that are overvalued for the announcement of the results of that company. Then we have number 3, earnings pairs. Here, this involves 2 stocks of the same industry, only one of which is announcing earnings. And what happens here is that we play the second stock. Now, an example of this could be Visa and MasterCard, for example. You may well get the earnings of Visa coming up. So say they're announcing their earnings tonight after market close. Well, then we'd be buying also a straddle or a strangle in MasterCard on the premise that MasterCard is also going to be making the same sort of move that Visa is making because of their announcements, but without such an increase in implied volatility, because MasterCard isn't actually coming out with their results. So they're not going to be having this huge increase in implied volatility because it's not their day of making the announcements of their results. Okay, that's sort of piggybacking. What we're doing there is sort of we're piggybacking with MasterCard on Visa the day of the results of Visa. Then echoes. Here, this is a bit more complicated. Echoes, here we have 2 stocks in the same industry. One which is announcing sort of between 1 and 18 days after the other. What we do here is we play the second stock in the direction of the first. So again, we could sort of use the example of Google and Baidu. If Google comes out and makes their announcements and sort of, what I haven't put in here is it has to, the stock has to make a more than a 3% move either up or down, so as we do play the second one in the direction of the first. So what would happen here is that Google comes out with their results and it moves down 4%. And Baidu's giving their results sort of 12 days after. Then we would be in the play of Baidu the day they have the 12 days after they come out with their results. We would be executing some sort of a strategy, knowing that implied volatility is going to completely crash down, because that's what happens after as soon as the results are released. more or less in the direction of what happened with Google. Google, what we said is, has gone down sort of 4%. So we would be, the strategy we'd be doing on Baidu is also to be falling in price. And then runners, these happen far less. These strategies that we just, we're not even there for the night. All we do, that these are sort of stocks that tend to run in the price of the open after the earnings announcement. So whatever stock, sort of, they give their announcement after market close, the day after they open up 2%. Well, what we do is we buy, even though they're already up 2%, we actually buy the stock still at that increased price and leave it until the end of the day. What happens here with runners is that just in the intraday movement, the day after announcements, they actually keep going in the same direction. David, what is the difference between this and just subscribing to the earnings module in OptionView? Because what I've said before, these the base of strategies that OptionView is giving us, but there are many, many, many strategies that are being given here every week. We have actually come up with a software and our own sort of tools that are picking, again, amongst these strategies that have been offered by OptionView. So these, what I'm going over here is just, I mean, is the types of strategies that we're going to be going over. And OptionView is just giving us the base of strategies on which we're going to pick the best ones to do. I would have thought it's pretty difficult to do them all. As I say, there are many there, and a lot. I mean, a lot of them don't work. A lot of them don't work. So what I was going to do was sort of just go over one or two. I think, I mean, sort of prime movers. I mean, Netflix, for example, is one that works out really, really well. You know, sort of the whole time. This last one now in January, if we get, I don't know, obviously not everyone's going to know the software of OptionView, but OptionView's got a sort of a time machine called Backtraders, where we can go back in time. There's about 13 years of historical data here that we can go back to and just move forward every half an hour and put on our positions, do adjustments, whatever. So for the Netflix one, Netflix is going to be a prime mover, and I'll show you exactly how this works. So we go back to the 20th of January when Netflix last gave its earnings. Always when we start these strategies, we ourselves don't actually, what we've been doing is we've actually come up with a different sort of time frame on going into the strategies, but I'm not going to go over all that now. But let's say that we buy this, I don't know, sort of at 9 o'clock. This is European, Central European time, 9 o'clock here, which would be 3 o'clock in New York, an hour before the market close. So here we are, the 20th of January. Okay, here, down here in sort of bottom left-hand corner, we have these sort of 5 pegs here. The pages for the different strategies that we've just been going over. So here we're talking about an E-primer. Netflix is always a prime mover. Netflix always seems to be cheaper on most occasions. Even though the implied volatility has increased an awful lot. So basically, if I put my my cursor over E primes, it's just sort of confirming what I've said before. These are stocks that make big moves. Buy a straddle on the day prior to the announcement and sell it on the day of the announcement. Despite buying inflated volatility, these stocks have a history of making such big moves that the straddle usually pays off. So let's look for, the thing is here, if I go to view and there's an option here to see the earning plays for the week. Thing is here, sort of the 19th of January was still not really, there aren't that many plays for this week, but I mean, usually when we're further into the season of earnings announcements, there are many, many more strategies here that OptionView is giving us for us to pick. That's why we ourselves, we've come up with our own sort of tools and systems to pick the best strategies from this space that OptionView is giving us. So Netflix here is going to be Tuesday. This is in Spanish. I'm sorry. This is Martes, which is Tuesday, the 20th of January here. Open Netflix. So let's go and have a look at Netflix for the Tuesday, the 20th. Yeah, we're on Tuesday, 20th. We'll look for Netflix, which is here. And if I right-click in this column under earning notes for Netflix, gives me the symbol, the quality. The quality is 37. That means it's in the last 2 years, which is the last 8 earning seasons. It's given an average of a 37% gain on the straddle or strangle or whatever we've actually bought to do the strategy. That's on the 8 past earnings. So this is the volume of the underlying, of the options of the underlying, sorry. And here it gives us the past success rate. So it's actually, in the last 8 times, it's actually won half of them, 4. But the average gain in percentage terms it's giving us is 37%, which means that it actually makes an awful lot more than what it loses. So each time it wins, it does in percentage terms. It makes an awful lot more than what it loses. So it goes on to say, just to buy a strangle or strangle. They're saying about an hour or so before the close on the 20th, and close the position anytime on the following day. So as I say, we're 9 o'clock, an hour to go. They're going to be giving the announcement's going to be happening AMC, which is after market close. So this is going to close at about 10 o'clock, and a few seconds or minutes after Netflix is going to give its earnings announcements. Let's look at the price chart. I don't know why, but they've it's actually the day before, and they're already implying here on the price chart this can't be right because there's some sort of error here. This here says it's the 20th of the 1st, which is today, and it's actually Netflix. What's happening with Netflix is it's gone down 0.4, so this isn't right. This is actually what's happened the day after, but the software, I don't know what, for whatever reason, it's already giving us that bar chart, the bar up there. This is the price chart of Netflix. You can see sort of in the past what sort of moves it's made on the day of earnings. Let's get the implied volatility. Implied volatility is the blue line, and again, you can see how it increases, as most stocks do, for the day of earnings. So we'll go into Netflix. – Usually, nearly all these strategies are done on weeklies options, but we have actually found through our own in-house, how can I get this? Through our own in-house software that it's sometimes been more profitable to do this on other expiry dates, not always on the weekly, on the first series of the weeklies options. Let me just. It's not giving me the options at the money here. Right. So where is it? 344. I don't know. Option view doesn't seem to be working that well at the moment because the at the money options are would be the 340 yet. The darker, there it is. Okay. Right, there we go. Pretty expensive. I mean, there's only sort of 4 days to go before these options expire. They're going to be expiring on the 24th of January, 4 days to go. And this, I mean, this is an expensive stock. It's at 344, but this straddle is going to cost quite a lot of money. It's because of the increase in implied volatility. So we're buying the 340 call and the 340 put. And this is just an overnight operation. I mean, we're just going to be there for until tomorrow, and we'll be selling this strategy. There we go. Typical straddle. So we'll execute that and go into tomorrow. Clayton, 30% return on Netflix options. What are the specific assumptions about when the option was entered and exited? E.g., 1 hour before close and 30 minutes after next day open, or is it a theoretical maximum gain during the day? Day after. It's a good question, Clayton. I couldn't. I'd have to actually call Option View in Chicago and ask them to give you the answer to that. What they said is that historically, it's usually best to leave the strategy until the end of the next day. When they say that, I don't know if they are basing this percentage return on that or not. I'd have to ask. Quite honestly, what we found with our own in-house tools and software, it really doesn't matter. It really doesn't alter the result that much how early you buy the strategy or how early you get into the strategy, whether it's 2 hours before, half an hour before. I wouldn't recommend sort of too near the end of the trading day because the bid-ask spreads do open quite a lot, and you're most probably going to get worse prices. I wouldn't sort of leave it later than 3:30 US time to get into these strategies. But I mean, whether or not you do it sort of half an hour before, 1 hour before, 2 hours before, doesn't really matter. What does matter is the next day. Our software and systems have come up with sometimes differing assumptions and proposals to what Option View have come up with, whether it's best to get out at the beginning of the day or leave it until the end. And quite honestly, it's a very valid question. The one you've made, and I'd have to ask Option View and see exactly if that percentage rate is sort of based on getting out of the trade at the beginning of the day or at the end of the day. Jim, yes, it's based on actual results over the past 2.5 years. But that's not the question, Jim. The question is, when that 30% return, is that based on getting out of the trade at the beginning of the day, the next day, or at the end of the day? That's the question. So I wouldn't know. I don't know if you know, Jim, but I wouldn't know. Anyway, we execute the trade, and we go to, they give the results the next day. Netflix was at 344. Jim at the end of the day. All right. Well, Jim is from OptionView, so at the end of the day, that 37%. And here, the move on Netflix. You can see here the percentage increase is sort of 65% or so. This is why that 37% is just an average. And it takes into account the losing trade that it's had in the last 2 years as well. So as we can see here, I mean, this has been a winner, and it's been sort of double that 37%, which is the quality indicator that has been designated to this strategy at the OptionView software. Now, the other example that I wanted to give was on earnings pairs. Actually, it was Visa and MasterCard back on the 29th of October, so we can go back to then. Just 1 second. We'll go back to the 29th, again using this sort of time machine that OptionView has. October 29th of last year. I did agree with Tom not to go on too long on this presentation. We sort of agreed 45 minutes, so I am taking into account.
Well, you can go a little longer if you need to. And
Okay.
Do you want Jim to be promoted or to participate, or do you just want to go solo?
Sorry?
I can promote Jim if you'd like to add him to the conversation.
Yeah, Jim, do you want to come in?
And you can go over 45 minutes. That's no problem.
All right, okay. Right. Jim, let us know and you can be promoted. So on the 29th of October, let me get this. 29th of October. We're going to go to earnings pairs. Here again, we're going to get a confirmation of exactly what we're doing. This strategy involves 2 stocks. A primary stock that is making its announcement and a secondary stock that is a company in the same industry which tends to jump with the primary stock. Again, we're sort of piggybacking on the stock that's made. Right, Jim, you there?
Yeah, I just got in. All right.
Oh, okay. Do you want to add anything to what to the question before?
I'm sorry, I missed it while I was trying to get in here. What was the question?
No, on the on how it's based, that the quality indicator. We didn't know. I'd never seen sort of it wasn't sort of until the beginning of the day, the end of the day.
Yeah, and the E primes of straddles, we put in there that you're better off historically holding it till the end of the day, and that is the time period that we look at just before the close of when to close that trade when we're calculating the quality indicator, which in this case the quality indicator is an actual return, like 37% on average, as you said, including all trades, winners and losers.
Yeah, that's it. Okay, great. All right. Okay, so I was going to continue here with earnings pairs. So going back to this example of the earnings pairs, what we're doing is we're going to be buying either a straddle or a strangle or whatever on an often non-inflated options of the secondary stock. Because remember that in this case, the case we're going to be seeing now, Visa's making the announcement, and MasterCard is not yet coming out with their announcement. So in principle, the options of MasterCard should not be inflated as much as those of Visa, because through the increase in implied volatility, because they're not the ones coming out with their announcements. But usually what happens is that MasterCard, the other pair of that industry, will move. It'll be influenced by the move in the company that is making the announcement, the primary company making the announcements. So what we're going to do, let's go to, where's Visa? Pairs, yeah, Visa. So Visa comes out with their announcements after market close today in sort of about half an hour's time. It's 9:30 on the 29th. And this says MasterCard 5141, this is the quality indicator 54, and it's won 4 of the last 5 announcements. Quality 54, again, this is sort of the average percent that it makes on all of the trade losers and winners. The volume of options for the underlying, and the past success rate. Here there is no play this time, because Visa and MasterCard announced the saying that, right, well, that's not a good example to do. All right. Well, I think it's pretty straightforward. The one of let's see if there's another one for 29th, let's see. Well, 29th or any time this week. I can't see any, not for the pairs. Oh, here. Okay, we can try this one here, which is on the 30th of October. PXD earn pair EGN, okay. So we'll go on to the 30th.
Yeah, or if you go back in time, Visa, MasterCard is, of course, a really nice example because they're such similar companies. And if you went back to maybe like July 29th, you would see the one for that quarter.
All right, we'll go back to July 29th. Okay, Visa announcing July 20, that wouldn't be July 29th, July 24th. July 24th. Visa,
let's see.
July 24th. Yeah.
Yeah, but you want to look at MasterCard. MasterCard is in 31? It says to buy a straddle in Visa near the close on 7:30 because they're announcing 7:31.
Well, MasterCard announces on the 31st.
Right. So you want to buy the straddle in Visa, which does not have earnings coming up, just before the MasterCard.
All right. Well, okay. So we'll go to the 31st.
The 30th, near the close on the 30th.
That's right. Okay. Yeah, because MasterCard is right. MasterCard is announcing before market open on the 31st. So when they're announcing before market opening, you've got to buy obviously the day before.
Right.
So 9:30 at night, MasterCard I'll right-click here, and again, it's confirming what we're doing. So it's MasterCard Visa Quality Indicator. Wow, 189. That's pretty incredible. Options volume for the underline and pass success rate 4 of 5. Yeah, of course it's right. Okay. So here, what we need to do is MasterCard's announcing tomorrow morning before market open. So what we're going to do now is buy a straddle or a strangle in Visa near the close. Close the position anytime the following day, though historically it has been profitable to hold the trade until the end of the day. Right. Okay. So we go to Visa. Let's have a look at Visa's price chart and the volatility. You see here, this is what Jim was saying. The implied volatility has crashed down because they've just announced their earnings the week before. So this is sort of the essence of what we're trying to do here. Obviously, the options of Visa have gone down an awful lot in value because of the fall in implied volatility. So it is a good idea. Obviously, if you think about it, it is a rational, good idea to actually to buy options here, buy the straddle or the strangle, and try and piggyback on the move that, in principle, MasterCard will be making because of its own announcements. So again, we'd be using, although as I said, it's what we found is that this also can work sometimes better using. It depends, or you can also sort of. I mean, when the strategy doesn't work out, you sort of lose less. Let's put it that way. You lose less than what you lose on these on the number 1 series of the weekly options. But anyway, we'd be buying one straddle here, the 215 call and the 215 put. These are 214.
Yeah, I think this one will be a good example of kind of how low risk it is, because I could just, of course, look at the price chart. This particular announcement, neither MasterCard or Visa are going to move very much. And despite that, you'll still just make like a little money.
Right. Okay, but basically, Jim, it's because they're pretty cheap. The options of Visa. It's because they've just had their. I mean, you can see in the implied volatility fall there that they are going to be much cheaper.
Yeah, you would think people would catch on, but it consistently moves along with MasterCard. Meaning the Visa options, yeah, or Visa underlying stock. If MasterCard moves a lot, Visa tends to move a lot in the same direction. And the options are not priced to reflect that. They're cheap for how much of expected move there is. Right.
Okay. All right, so we converted the trade. We'll go until the day after. Visa was at 214. I didn't look at the price. Well, we'll see. Look at the price of MasterCard now. Day after Thursday. And as Jim says, Visa doesn't really move an awful lot, but it's moved enough to make us sort of 18% on margins. Here we go, 18%. It cost us $277 to buy the straddle, and we're up $52. Do you want to say anything, mention anything on that, Jim?
Well, it just shows you that people who are familiar with earnings, sometimes it doesn't move that much earnings. It pretty much hits what everyone was expecting. Other times, of course, either the news is unusual or it's not what they were hoping for, and it gets hit. It either goes up a lot or down a lot. When it moves a lot, that's when you make a lot of money with this trade. But even when it doesn't move, as you said, you don't lose much, or you even make just a little bit. And it's only holding it for a day.
Yeah. So I don't know. I mean, we could try here going until the end of the day, see exactly what happens. We'll go until sort of an hour before the close on that day. And we actually earn even more. You actually double. You actually make over 36% if you wait until the end of the day. So this is something that we've actually discovered ourselves. It is important. It does make a difference sometimes. It can really affect the overall result for the strategy if you do decide to leave the trade on until the end of the day or not. Here we can see it's more than doubled the result and leaving it until the end of the day, which is interesting.
And that's common. It just shows you that historically it will do better if you hold it towards the end of the day. But everyone here, at least I know, and I'm sure most of our customers, they see that initial pop, see how much you make, and sometimes it tends to keep running in that direction, but other times you see it reverse. And you know, if you got 50 to 100% return and you see it starting to reverse, you just say, I'm happy, I'm getting out of here.
Of course. Well, that's psychology as well in all of this. So. But yeah. No, of course. I mean, I've actually realized through the earnings tool in the option view software that I'd sort of say 80% of the times it does actually recommend you to stay until the end of the day. I'd say more or less 80% of the time it does actually sort of advise you to stay in the trade until the end of the day. So what I can do quickly now is try and show, I mean, I would have thought sort of the echo strategies, these ones, the more, this is a new type of strategy. This is sort of the strategy which is most difficult to explain. Again, it involves two different stocks from the same industry, the same as the pairs. If the primary stock announces and jumps more than 3%, either up or down, has to move more than 3%, either up or down, then the play on the second stock does come into action. And that is that it has to be giving their announcements from 1 to 18 days after. And what we do is we take a position in that stock for their announcements in the direction that first primary stock had made when they had given their announcement. So what I thought is I'll try and give an example of this so people can sort of understand this as best possible. Do you want to make any comment on this strategy,
No,
Jim?
well, that pretty much explains it. And as you said, I've never seen anything written about this ever anywhere. Yeah. It's something that we discovered just in testing. Yeah.
So what I'm doing here is I'm going back to the earnings seasons of October of sort of the autumn of last year, and I was gonna, again, we can view sort of the weekly earnings planner at Option View. This is the base of strategies that they have at Option View from which everyone can pick. And it was what I did want to do was eBay. Here's eBay and Google. This is an echo. The eBay action today, quality 42, and options volume 26,000. So let's close this, go to eBay. Let's read exactly eBay and Google. So eBay, Google, quality 42, past success 2 out of 2, right. If eBay jumps 3% or more on the 16th, eBay is announcing after, no, hang on. eBay is announcing after market close today on the 15th. If it jumps 3% or more, the day after on the 16th, then we'll be taking a position on the 16th of October to profit from Google moving the same direction for their earnings. Why is that? Because Google is actually giving their earnings here on the 16th. So Google, the condition is that it has to move more than 3%, and the condition is that it has to be giving its own earnings announcements from 1 to 18 days. Google's actually giving it the day after, so 1 day after. So anyway, eBay, let's see how it finishes. eBay 52.90 on the 15th, 10 o'clock at night here in Europe, 4 o'clock in New York. Okay, well, it seems to be closing at the same price anyway. It doesn't really matter. We'll see now what it sort of jumps the day after.
This is after the market close, so you're going to have to go to the 16th in the morning to see the effect of the announcement.
That's right. I'm going to go to 3:30 the next day. So eBay finished at 58.91. Look at the price chart. Why is this, Jim? Why if we're on this? Why if we're on the 14th? Why is it giving us this bar up here on the graph? I don't understand that. Shouldn't be doing that.
What happens when you click on that line? It's showing the date for the 15th.
Yeah, that's not right.
Let me see.
Something wrong there. I don't know why. It must be some sort of glitch or something there, because that's not correct. But anyway, well, we can see from that it's going to jump the next day. This is actually the bar for the 16th, not the 15th. But anyway, something wrong here in the software. But okay, so we go to the next day. Stephen, are the trades completely binary, meaning no delta adjustments after the event? Simply get in and get out. Exactly. You just get in and get out. There's no adjustments. There's no nothing here. No adjustments at all. So anyway, the next day, software is a bit slow. eBay, the 16th.
Yeah, it's down on the 16th.
My software isn't. It's not. I don't think it's updating properly. Now it is. No, it's not. Sorry about this. Hang on, the 3:30. Right, there we go. It's down 4.3. So again, the conditions are right, so as we can get into the play on Google. Google's announcing 1 day after, which is fine, and the move is more than 3%. It's gone down 4.3%. So we go to the end of the day, sort of 9:30. Google is down 0.8 for the day. So what we're going to do is buy a position in Google that is going to sort of exploit the crush on implied volatility and make a bearish move. So we can do a simple thing like just sell a call spread, for example. This is I clicked on Google and it gave me Visa. Okay, Google. Sorry about the speed of this. Right, there we go. All right. So what we can do here, what we're going to try and do is we're going to put on a position, a bearish position, because what's been implied to us is that Google's going to move more or less in the same direction as what Baidu did on its announcement day. And we also know that the implied volatility is going to go down, so we're going to try and exploit that as well. Implied volatility of Google is sky high because they're about to give their earnings announcement. So, for example, what I don't know. I mean, for example, what we can do is just sort of sell a call spread. And like that, we'd be short Vega and volatility. We'd be short deltas. And that's sort of the graph that we have for these options. These options are expiring in 2 days' time.
So it looks like you guys get that kind of a drop and you'll double your money.
Yeah. Right, Google makes a move. Google is making a move of, I don't know. But it's not showing. Oh, I haven't, hang on. I haven't converted the trade. Hang on 1 second.
Yeah, you want to convert the trade, then go to the next day.
Yeah. All right. Right, convert the trade, sorry about that. And we go to the next day, 3:30. The move isn't that big on Google. It's only gone down 132. So we were right about the direction. It has gone down, but the thing is that all that premium in the options has completely disappeared because we're now after the announcement of their results. And percentage-wise, it's huge. $456. So we're over 510%. And that's more or less an example of, I think what I've found is that people tend to have difficulty understanding sort of how the echo strategies work. But basically, when we do have the conditions to get into the strategy, what we're trying to exploit is more or less the fact that the underlying is going to move in more or less in the same direction as the primary stock, and also that crush on volatility, the crush on time premium. It'll be, post earnings, it'll be a period, and all that time premium that's been inflated in the options before the release of the results, of the earnings and results, has gone out of the window, has completely disappeared. So again, another good trade. I don't know, anything else, Jim? I mean, these were sort of the sort of 2 or 3 examples I wanted to use.
Yeah, no, I think that was a good overview, and you can see that at least in the software, we give very specific instructions saying, on this date, by this kind of trade, and so.
That's right, yeah.
Do you have any performance results on how those trades have done as a collection?
Well, those statistics that we give you show you exactly what happens to that particular trade. When we have it set so you can import trades, each individual can choose, what kind of quality settings, what they want to include or not include. But in all those different things, it's going to tell you exactly what happened. Like, the last 2 times this is available, it says past success, 2 out of 2 or 2 out of 4. And it's going to tell you the exact return you got. If it says 189, means if you played this every time for the last 6 times, you would have averaged 189% return on this trade every time.
Yeah.
Now that's an average. Some would have won and some would have lost, and it's going to tell you 4 out of 6 won. But so it's giving you for those exact performance statistics for each individual trade that you're considering. And it's up to you whether you want to take that trade or not.
I mean, what sometimes puts people off is that they see sort of the past success rate is sort of 3 out of 8 or something. So it's, it's only won 3 and lost 5. But the thing is here that, if the quality indicator is giving sort of 40%, what it means is that those times that it does win, it wins an awful lot more in percentage terms than what it than the percentage amount that it of the losses. People have got to understand that as well.
Exactly. You could have lost, 20% on 5 of those trades, but you made 300% on the other 3.
Right. That's right. Yeah, that's right. So,
I guess across all the recommendations you've made, have you compiled like a total win percent, like an average, or an average return that you've made on all the trades you've recommended?
Again, it depends on the quality. You can go to pretty low quality if you prefer, just to look at them.
That would be
Other
interesting.
people use them to do other things too. We suggest, say, here's what happens when you do a straddle, but there's people that use this information to instead say, I'm going to play it directionally. I think they're going to have good earnings, and I'm going to do maybe a diagonal calendar spread in the puts to take advantage of that vol crush and do a completely different trade. So this information is based on, a specific way of trading, but you can use that information to, fit into your own style of trading too.
Sure.
Yeah, Jim, what we've done is that for particular trades that we've been backtesting from this earnings tool, things I haven't got them with me. I myself haven't got the statistics, but I can get them. For doing a particular set of trades, time after time after time, we have got statistics which are excellent for these earning trades. MasterCard and Visa is one. I think Google and Baidu is another. I don't know. There are several there that we have got statistics for. So, I can, another time I haven't got them with me at the moment, but for a certain pick of these strategies that OptionView is offering, we have got statistical results for doing that time after time after time, at least for the last 2 years. What we were thinking of doing as well was actually going further back into time, applying the same strategies time after time after time on those particular underlines, and getting a base of results of those strategies on a far longer time period, not just 2 years. So.
Ricardo, do you have, I know you don't have them exactly with you, do you have like a rough feeling of what the numbers might be?
No, they're brilliant. They're brilliant. They're excellent. I'm not sure, Jim, if you guys have even sort of contemplated that, what I'm saying. You sort of you've gone back in time in the last 2 years. But if you apply these, especially the ones that really do sort of work out well, the statistics are incredible.
Yeah, I guess to give you an example, like he was talking about the MasterCard Visa, and we've had this out for, what, a year and a half or so, about 5 earnings. Maybe it's 4 earnings announcements now. And MasterCard and Visa was successful 4 of the last 5 times. It averaged 54%. So you could say if I did $1,000 each one and made, 54% each time, I was successful 4 out of 5 times. Are you talking about each time you're going to keep rolling that money in. So now instead of $1,000, you're putting in $1,500. Now you're putting $2,250. Now you're putting, a rolling, or just the same dollar amount for each trade.
Well, money management, yeah. I mean, what we could, I tell you, I mean, we could come up with. I mean, I've got a. I mean, what part of the team of option elements that I have specializes in money management. I mean, we can come up with statistics also where we apply different methods of money management, and we'll see what sort of statistics we come up with. But what I'm trying to say is that these patterns in these earnings strategies existed before 2 years ago also. that's what we've realized. That's what we've come up with. So it's interesting. It's interesting. And if you apply different techniques of money management, I mean, the results can get even better. So anyway, sorry.
Yeah, I was going to say it's excellent, and I don't see any other questions, and we're just a little bit over an hour. So if you have any last things to say, we're probably getting close to wrapping it up.
No, just sorry, Jim. Jim, is there anything else you wanted to say?
Oh no, thanks for letting me join. And if people have questions, they can call us anytime.
Right.
Thanks, Jim. I appreciate you coming on a short notice.
Oh, sure, anytime, Tom.
No, Tom, I just very quickly say, I mean, I'll be to everyone. I will be coming back to Capital Discussions. I'm going to be starting an alert service with Capital Discussions of 3 sort of very quick strategies in and out. They're sort of weekly strategies based on the Russell 2000. There's a volatility strategy there as well, and there's strategies where the exposure to the market is very, very little. We're talking about strategies from sometimes from one day to the next, or maybe sort of just 3 to 4 days. There's a play there on volatility as well, which is less frequent but works very, very well. And if you could also join me for that webinar when I present the service, that would be great, because these really are trades that work wonders. We've got incredible track results for them, and they're very concise, in, out, quick trades. You don't have to be sort of the whole month, tied to the market, tied to the trade, doing the adjustments, this, that, and the other. You sort of just get in and get out whenever you want. And I think it's going to be it can be an alert service that would be in the interest of many sort of subscribers and traders. So just quickly mention that. And no, thanks to you, Tom, for letting me join tonight. It's been great.
Oh, thanks, and again, Ricardo, you were also very short notice. So again, we appreciate you coming on no problem. 2-day notice. Thanks again.
No problem. All right.
And thanks everyone for joining us, and we will see you next time.
Okay.
Thanks.
Thank you, everyone. Thanks.